Hello there. Welcome to Financial Accounting N4. Still on question paper from November 2022. Right now, we want to look at question 6, and the question 6 is on statement of cash flow. And we've got a question that we have here, so we are going to go through that question. The question reads: use the information below to calculate and draft the following note with regard to the statement of cash flow for nom traders for the year ended 31 December 2021. So what we have here on the first part is we have got the calculation of cash received from customers. So this is the part that we are going to start with, and remember it is 6 marks. So what we are going to do here is we are going to first of all put down the formula that we are going to use there to calculate the cash received from customers. Then we put it on the answer section in the form of a table now. But basically, in the table, the formula that we are going to employ there is going to be revenue. We add trade. We add trade receivables. We add trade receivables at the beginning of the year. At the beginning of the year. At the beginning of the year, and then after that, we subtract trade receivables. We subtract trade receivables at the end of the year. So if we do this, then we find now the cash received from customers, which is the cash inflow for the year. So here is now the cash inflow. Cash inflow for the year. So here, remember, this is the statement of cash flow, and we record the actual movement of cash in and out of the business. So that's why here now we are recording, we are adjusting for trade receivables at the beginning and the trade receivables at the end. Here, the adjustment that we are making here of trade receivables at the beginning, and then here we are now subtracting trade receivables at the end, because we are trying to see the actual cash that was received for those trade receivables. Remember, trade receivables represents those customers that we sold goods to on credit. They owe us some money, so when they pay back, that amount that they pay back, when they pay back, now we can now record them in the statement of cash flow as there is now actual movement. So basically, the issue is when there are credit sales that have taken place, we don't record anything because there's no cash movement that has taken place. So that's why we are making these adjustments so that we see the actual movement of cash. So that is what we have in terms of this formula. Then we're going to present it now in the answer section. So before that, we look at the balances that we are given in the question. So you'd see that we have got information that we have here for the question. We have information that is given there, right? For this information, we are given a table that we are given there, and the table is giving us some balances that we are supposed to use in the calculations. So what we are going to do, we are going to go through these balances. So we have got these balances for nom traders, summarized statement of financial position is at 31 December 2021. Then we are given the balances for 2021 and then for 2020. Remember, 2020 is the previous financial period, and the current financial period is 2021. So this is the information that we have. And then we also have got the additional information that is given there. We can go through the information. We've got equipment with a cost price of 50,000 at carrying value of 30,000 rands was sold during the year. And then on number 2, we've got the owner of the business made no drawings during the year. So if you come again down, we see that we have got another information. Nom traders summarized statement of profit or loss and other comprehensive income for the year ending 31 December 2021. Then we are given the information below in the table. So this is the information that we have. But according to the calculation that we want to make on 6.1, we want to calculate the cash inflow for the year. And we said we are going to say revenue. We add trade receivables at the beginning of the year. Then we less trade receivables at the end of the year. Then we get the cash inflow for the year. So if you come here, this is our figure for revenue, 444,000 here. This is our figure for revenue. Then we try to see the figure for trade receivables at the beginning of the year. So we've got trade receivables here at the beginning is in 2020. This is 29,350. Then at the end is the figure that we are given for the current year, which is 94,325. So basically, we are going to say 444,000 for revenue. We add this one at the beginning, and then we subtract this one at the end. So we can go in our answer section, and then we just summarize that. So if you come here now, this is the calculation of cash received from customers. Then we are going to start with revenue. We are going to start with the revenue. The figure for revenue is 444,000. Then we are going to add the figure for trade receivables at the beginning of the year. Trade receivables at the beginning of the year. And according to the information that we have there, we've got 29,350, and we're adding, so we leave it as a positive. Then we less trade receivables at the end of the year. Right, trade receivables at the end of the year, the figure that we are given there is 94,325. That is what we have. We are listing that. Then after that, now we can calculate the cash inflow for the year. This is the final figure. So for the cash inflow for the year, we are now saying 444,000. We add 29,350. Then we subtract 94,325. With that, now we get 379,025. Right. So this figure is the cash inflow for the year, the figure that we're looking for, which is cash inflow for the year. So this is the figure that we have. So on the first part of 6.1, that's what we have. Then we come here now. We now want to go to the second part. If you go to the question, you will see that the second part is calculation of cash paid to suppliers and employees. Calculation of cash paid to suppliers and employees. So let's try to see there. Obviously, we want to put a formula first to see which is going to help us in terms of finding that figure. Right. This figure, the figure that we are going to start with, we are going to start with revenue as a negative figure. Then we are going to adjust for net profit for the year, and then we get the figure for expenses for the year. That's what we are going to do first. And then for us to adjust that, the formula that we are applying there is that revenue, the formula that we use in the income statement, we say revenue, then we subtract expenses. Then we subtract expenses there. We get our profit, our net profit. Let's just say profit. That's the figure that we get there. Or net profit. Let's just say net profit here. Right. So here we are trying to find the figure for expenses. That is the first section of that of the calculation of cash paid to suppliers and employees. We first calculate the figure for expenses, because the figure for expenses we won't have it. So basically here we are just making expenses the subject of the formula. So if you make expenses the subject of the formula here, we are going to remain with a negative expenses. And then you say equal to net profit. Then you subtract your revenue. Then you subtract your revenue. So that's what we have. So it means so if you interchange this formula again, it will become negative expenses is equals to this one is negative, can come here, negative revenue. Then we add our net profit, since our net profit is positive here. So we are going to leave it like this. So the first part of the calculation of cash paid to suppliers, we are going to employ this formula here. This is the formula that we are going to employ here. We're going to start with revenue as a negative figure. then we add our net profit. So that's what we are going to do there. And then obviously the figure that we are going to have for expenses will be a negative figure. So we go there and summarize and put that layout in terms of the formula that we've just put there. So if you come here, we now go down to see the figure that we have. Obviously, revenue, we now know that is 444,000. We are having 444,000 here. And then having our 444,000, then our net profit, we try to see the figure for net profit that we have. Net profit, we are seeing that is 15,824. So we are going to start with 444,000 as a negative. Then we add our 15,825 there. So we can go and just summarize that one in the calculation part. When we come here now, we go to that statement, that is 6.2. So we have a calculation of cash paid to suppliers and employees. So if you come here now, we are now saying we are going to start with revenue. And the revenue, remember, we are going to put it as a negative figure here, which is 444,000 as a negative figure. And then we are going to adjust for net profit for the year. So if you come back here to find about the figure for net profit, you see that this is the figure for net profit, which is 15,825. So this is the one that we are going to put there. Remember, we said we are going to add it to that one. We are going to add that figure to the figure that we have there. So if you add that figure, which is 15,825, we are going to put it here, 15,825. 15,825 is the figure that we have there. So we are going to add it to the negative figure that we have there. So the answer that we are going to get here is 428,175. So remember, we are saying negative 444,000 plus 15,825. So obviously, the figure that we're going to get here will be a negative, so show it in brackets. So this figure represents expenses for the year. This figure represents expenses for the year. So this is the figure that we have there. Then after that, we are going to adjustments of non-cash items. Adjustments of non-cash items here. For non-cash items. Right. For adjustment for non-cash items, remember, we have got interest received and interest expense. We know that these figures, we are going to adjust them in the statement of cash flow. They are going to be adjusted in the next statement of cash flow. So we are going to remove them here when we are calculating cash paid to suppliers. We are going to remove them. We are going to first of all adjust for interest received. Interest received in the question. So remember, when we are calculating cash paid to suppliers and employees, all the income or profits that we are going to see, like profit on disposal, we show them as negatives, and all the expenses that we are going to see, we are going to show them as positives. So that's the issue there. So interest received, obviously, we are going to show it as a negative, and then if you have got a profit on disposal again, we are going to show it as a what? As a negative. Then other expenses, now we can show them as positives as we try to adjust to find the figure that we want to find there. Right, we go back to find out what we have in terms of interest received. If we come here, interest received, we have got 8,400. So we come back here to enter that figure, which is 8,400. So we have got 8,400 here. And remember, we said this is income, interest received is income, so we show it as a negative. So we can go down and try to see what we have next. So if you go back to the question now, we try to see what from interest received we have. We then go down and see that we've got depreciation that we have there, and depreciation is 163,500. And remember, depreciation is an expense charged under operating expenses in the income statement. So we are going to show it as a positive. Then we go back now to adjust for depreciation there. So now here we have got depreciation. Depreciation. Right. So for depreciation, we are going to show it as a positive, which is 163,500. Then we go back to see what we have there next. We also have a loss on sale of non-current assets, which is 5,000. Remember, this is an expense again, so we are going to show it again as a positive. We'll show it as a positive. So another hint that you can use there is that when it's in brackets, it means for that calculation on 6.2, we are going to show it as a what? As a positive. So this one we are going to show it as a positive, loss on sale of non-current assets. So here we have loss on sale of non-current asset. Right, we have got an amount of 5,000. Remember, we are saying we are again showing it as what? As a positive, because loss on sale is an expense. Remember, loss on sale of on disposal or on sale of a non-current asset, I will show it under operating expense as an expense. So we can show it as a positive there. Then we go again to see what we have there. Right, after depreciation, we also have interest expense. Right, for interest expense, we have 14,000. And remember, this one is an expense again, so we are going to show it as a positive. So we go there and put that one, which is interest expense. Here we've got interest expense. And the interest expense here is 14,000. So we are going to show it here as a positive. Then we try to see what we have next there. So that is what we have. So we go back there to check the next adjustment. So remember, we are not adjusting for administration costs. We didn't adjust for administration costs and didn't adjust for rent. We are also not going to adjust for this is what we have. We are not also so this is what we have in terms of rent income, and then we've got administration costs. We are not adjusting for this because remember, the calculation that we are making is the calculation for we are making the calculation. We are calculation for cash paid to suppliers and employees. So if you go back to our question here, we are making a calculation of cash paid to suppliers and employees. So that's why we are not adjusting for those administrations. We are not adjusting for the rent income because they are not part of what of suppliers and employees. Employees, we know they are workers of the business. Then we've got suppliers. These are the organizations or businesses that are supplying us with goods and anything else that they are supplying us with. So that's why we are not adjusting for those figures that we have skipped there. So we can go on to see what we have next there. If you check there, we are moving from interest expense. So that's what we have there. So if you look up beneath interest expense, we've got wages and salaries. These ones we are not going to adjust them again because they are part of the amount that we are looking for. Remember, we are looking for the cash paid to suppliers and employees. So wages becomes part of the cash paid to employees, and also salaries become part of that. So you're not going to include them because they are part of that amount. So with that, it means we have exhausted what we are supposed to include there. Then after that now, after adjusting for those expenses, we are supposed to add inventory at the beginning of the year. We are supposed to adjust for inventory at the beginning of the year, and then also adjust for inventory at the end of the year. So basically what we are going to do is we are going to add inventory at the beginning of the year, then we subtract inventory at the end of the year. Then after that also we are going to adjust for trade payables. That is, we subtract now, we do the opposite, because trade payables is a current liability and then inventory is a current asset. For trade payables, we are now subtracting the balance that we are given at the beginning, and then we add the balance that we are given at the end. So here we can just come and check those figures in the list of balances that we have there. So those figures were given in this list. Remember, we said 2020 represents at the beginning and then 2021 represents at the end. So if you come to inventory, we are here. Inventory at the beginning is 27,000. This is the one that we are going to add. Then we subtract 91,200. Then we do the opposite now for payables, trade payables. We are going to subtract 90,000. Then we add 118,775. So we can just simply go there and make that adjustment. So when we are here now, we are now saying from there, we are now adding inventory at the beginning of the year. At the beginning of the year. And then the figure that we have for inventory at the beginning of the year is 27,000. And we are said we are adding it, so we leave it as a positive. Then we go to less inventory at the end of the year. Inventory at the end of the year. So the figure for inventory at the end of the year that we are given there is 91,200. So this one we are subtracting. So those are the figures that we have. And then after that, we now adjust for trade payables. Right. So now we adjust for trade payables. So we are now saying we are now doing the opposite. Here we are adding at the beginning. Now we are lessing at the beginning. So we are now saying less trade receivables. Less trade payables at the beginning of the year. At the beginning of the year. And then the figure that we have for that one, is 90,000. So we are subtracting 90,000 here. Then obviously we add now the balance that we have at the end. Then we add trade payables at the end. So when we do that, the figure that we have there is 118,775. These are the balances that we have in the question, so we can come back to check if we are entering the correct figures. 90,000 here is 90,000 for trade payables. Trade payables is here, 90,000 at the beginning. Then we've got 118,775 at the end. So these are the figures that we just entered there. Then having done that, now we can now make our calculation to find the final figure. And the final figure represents the cash paid to suppliers and employees. So we are going to start from where it's starting there. We are starting from, we are making the calculation from the top. We are seeing that it's starting from 444,000. Then we negative 444,000. We add 15,825. Then we got 428,175 as a negative. Then we make the calculations of there we subtract 8,400. Then we add 163,500. We add 5,000. We add 14,000. And then we add 27,000. We subtract 91,200. here. Then we also subtract this one. We are supposed to subtract the brackets are in the wrong position. We're supposed to subtract 90,000 here, and then we add 118,775. So the answer that we are supposed to get there is 289,500. So that's the figure that we have for cash pay to suppliers and employees. So with that, now we can move on to the next section of the question. That is, we are now moving to 6.3. We are now moving to. So maybe before we move on to the next stage, we may try to understand why we are adjusting for inventory here at the beginning and then inventory at the end. The issue is that when we are buying this inventory, we are paying money to suppliers. This is the money that we are trying to calculate. So by adjusting inventory at the beginning and inventory at the end, we are trying to see how much did we pay for new inventory that we purchased. So inventory at the beginning represents that this is the inventory that we had. For this instance, we had 27,000 at the beginning. Then it increased to 91,200 at the end. So it means we paid money to suppliers, which is 91,200 minus this one. So we also adjust for payables because remember, payables represents those businesses that we are owing money as a business, and the balance that we have at the beginning is the balance that we are owing there, and the balance that we'll be having at the end will represent the movement of cash that has transpired. If the trade payables have reduced, it means we paid something to the suppliers. So that's why we are adjusting for trade payables at the beginning, and then we adjust again trade payables at the end. So we move on to the next part of the question. Right, if you move on, the next part of the question requires us to prepare the notes to the statement of cash flow for non-mom traders for the year ended 31 December 2021. So on that one, we are going to start with net profit before taxation. Net profit before taxation. Then we are going to make some adjustments in terms of, again, interest received, depreciation, some non-cash items. We also adjust them, including interest received and interest expense also are going to be adjusted there. The reason why we adjust for this interest received and interest expense, remember, when you are now in the statement of cash flow, we under operating activities, when we are now calculating the cash effects or cash inflow of operating activities, we are going to adjust for interest. So that's why we adjust it before we start the statement of cash flow, so that we do not adjust it twice. So, and then we also adjust for non-cash items like depreciation, and if you have a loss on sale of a non-current asset or a profit or sale on sale, we also adjust it there. Then we get the figure for operating profit before working capital changes. Then after that, now we adjust for working capital changes. That is, we are going to look for movements in terms of inventory. Did it increase or decrease? And then we are also going to look at movements in terms of current liabilities in the form of trade and other payables, and we look if the trade and other payables increased or decreased. But basically, we are going to see how we adjust in terms of that. So remember, we are saying here the figure that we are starting with here is we are going to start here with the figure for net profit before taxation. So here we've got net profit before taxation. So this figure is given in the question, so you can go back to check the figure, net profit before taxation. So if you come down here, you'd see that net profit, we are given net profit for the year is 15,825. So this one is the net profit before taxation. This is the figure that we are given before tax is charged. So we are going to start with that one. So it is 15,825. So you can put it in this column. Then from that, we are now going to make some adjustments. We are going to make some adjustments. So remember, when we prepared the income statement, interest received, we added it after net profit, after operating profit, operating net profit, we added interest received as interest income. So we are readjusting it now. Since we added it, now we are going to subtract it. So here we are going to have interest received. So we can go back to check the figure, to recheck the figure that we have for interest received. Interest received is this figure, 8,400. So it was adjusted here as an addition. So we are doing the reverse to remove it. Since we are saying we are going to readjust it again in the statement of cash flow. So we've got 8,400. So when we are adjusting it there, we are sort of removing it from the adjustment that was did earlier. So 8,400, we subtract 8,400, subtract it, and then we go to the next step. That is, let's try to see. Obviously, we have depreciation. Depreciation. Remember here, when we adjusted for depreciation, we subtracted. So here now we are removing it. Remember, depreciation is a non-cash item, and here we are preparing the figures that we are going to use in the statement of cash flow. So non-cash items, we don't include them in the statement of cash flow. So here we subtracted it as an expense. So we are now going to add it back to remove it. So we go back to the balance that we have there. So we have 163,500. This is depreciation. Depreciation, and the figure that we have is 163,500. And we said we are adding it. They were doing the reverse of what we did in the income statement. Then obviously we've got a loss that we saw there in the list of in the comprehensive income. We've got a loss on sale of non-current asset, which is 5,000. So here we are saying this is also a non-cash item. Here it was subtracted, it's a loss, so we're going to add it back to remove it. So we come here now, we say loss on sale of non-current asset. Loss on sale. Loss on sale of non-current asset. So the figure that we have there on loss on sale of non-current asset is 5,000. And remember, I said it was subtracted there, so we are adding it back. So that is what we have. And then we try to look for another adjustment that we have there. Then after loss on sale, we can also go and check at other figures. Remember, we said interest received and interest expense, we adjust them. We have got 14,000 for interest expense. So we are going to also, here we are subtracting it. We are seeing that it's a subtraction here. So we are going to add it back to remove it. So just do the opposite. Here now we are on interest expense. Right. So this is what we have there, and then the figure that we have there is 14,000. So we said we subtracted it. So we are doing the opposite here. We are adding. So that's what we have there. So these are all the adjustments that we have. So we have to take note that when we are the first part of the adjustments, we just adjust for non-cash items here, including interest received and interest expense. And this is what we have done here. And then we calculate here to find the figure for operating profit before working capital changes. The figure that we are going to get there is operating profit before working capital changes. So the working capital changes, we are going to see because working capital basically we are saying current assets minus current liabilities, that is working capital. That's how we calculate working capital. So when we say working capital changes, we are saying the elements of current assets and elements of current liabilities, we're going to adjust them there. Those are the working capital changes. So here when you calculate here, when you make the calculation from 15,825, we subtract 8,400. Then we add 163,500, we add again 5,000, we add again 14,000. You're supposed to get 189. 189,925. So this is what we have. And then here we now move down to make the adjustments in terms of working capital changes. So if you come here now, we now say working capital changes. Working capital changes. And we said working capital basically is calculated as current. So let's just say working capital is equal to current assets minus current liabilities. This is the formula that we use to find working capital. So when we are looking for working capital changes, we are looking for elements of current assets and elements of current liabilities. Their movements, these are the ones that we are going to adjust here. And basically, we are mainly concerned about inventory changes and trade and other receivables, and then we've got also movements in trade and other payables. Remember, receivables can come in the form of prepayments for expenses, can be receivables, and also we have got accruals for income can be also receivables. And the opposite is true when you go now to payables. We are talking about accruals of expenses and prepayments of income. So that's what we have in terms of the payables and the receivables. So here we are just going to see what is happening in terms of inventory. So we go to the list of balances that we have and try to look at the movements that we have for inventory. So if you come here, we have the list that we have there for balances. For inventory, we are seeing that it was 27,000 and it increased to 91,200. So what we are just going to do there, we're going to say 91,200, then we subtract 27,000. And we are trying to see at how much did it increase. And if the difference between the two there, we are going to see that 64,200. So this figure is an increase, it increased. So what happens when inventory increases is that we bought inventory, so it increased. So by buying, it means money was going out of the business. So this is an outflow of cash. This is an outflow of cash, and we are going to show this figure as a negative. So basically, when we are dealing with current assets, remember inventory is a current assets. When it's an increase, so you can just say increase of current assets, we subtract. Then a decrease of current assets, we are supposed to add there. The opposite is true for current liabilities. For current liabilities, if it's an increase of current liabilities, we do the opposite. We are now adding increase of current liabilities, we add, and then decrease, we subtract. So basically, we can use that as a way of making it easier when we are dealing with these movements. So here we are saying we have got an increase, so we are going to subtract this one, 64,200. So we go to the answer section there. And then we are going to start with inventory, and this one is we said it's an increase of inventory. And we are going to put in this column, which is 64,200, and we show it as a negative. Then we go to the next one, and we go to trade and other. Trade receivables is here. We are seeing that trade receivables is also a current asset, and we are seeing an increase here. So we are here on increase of current asset here. Increase of current asset. So it means we are also subtracting here. There's an increase of receivables, which is a current asset. So we are going to say 94,325 to subtract 29,350. So we say 94,325, then we subtract 29,350. So when you make that calculation, we are going to get 64,970.75. So this one also is a negative because it's an increase of the current asset. So here we are seeing an increase of trade receivables. Increase of trade receivables is a negative 64,975. And obviously now we are going to look for payables. What happened to payables? So on payables, we see there is an increase of payables, and the payables are current liabilities. So here, for current liabilities, this is a section for current liabilities. When there is an increase, we add, and here there's an increase, and we try to see what increase do we have there. We have got 118,775. Then we subtract 90,000. Then when we calculate that one, we're supposed to get 28,775. So it means this one we are going to add it because it's an increase of a current liability. So here we also have an increase of trade payables. Right. That increase we said is 28,775. Then here we can underline to find the net figure that we are going to put here. The net figure that we are going to put here. So we can just say 64,200. 64,200 there. Then we this is a negative 64,200. Then we subtract 64,975. 64,975. Then we now add 28,775. So we now add 24,775. So let's try to see what we get there. So there we are going to get negative 100,400. Negative 100,400. And this figure is going to come here. Sorry, it's going to come here where we have the working capital changes. So the working capital changes resulted in a negative 100,400. Then we put it in figure in brackets there. So what we are going to say now, we are going to say this one 189,935 minus 100,400. Then we get 89,525 as a positive. Now, so this is representing a cash inflow since it's a positive. So this is the figure that we are going to carry in the statement of cash flow under operating activities is a positive of 89,525. So this figure is cash generated from operations. This figure is going to go as cash generated from operations. So we can just give it a name there, that is cash generated. Cash generated from operations. Remember, in the cash flow statement of cash flow, we've got three sections. And we've got the section for operating activities, section for investing activities, and section for financing activities. Those are the three sections that we have. And when we make adjustment for those three sections, that's where we are going to have the net cash inflow or outflow of cash and cash equivalents. That we are going to add to the opening balance of cash and cash equivalents, and then you get the closing balance of cash and cash equivalents. So that's what we have in terms of statement of cash flow. So according to this question, we've come to the end of the question. Thank you for listening. Those who haven't subscribed, please subscribe. Stay tuned for more videos to come as we prepare for exams. With that, I am out. We'll meet again in the next video.